the Gould Mine podcast.
What are some of the inherent differences from an operations standpoint, right? Mm-hmm. When you're looking at, say, well, obviously, you know the hotel sector really well. I don't know how much of our audience is going to know hotels, but, you know, hotels, multifamily, what are some of the key operational differences that distinguish the, flex industrial versus like some of these other asset classes?
Yeah, I mean, it's a little bit more aligned with like, I feel like a lot of people in our space are in they're in hotels or short-term rentals or self-storage, RV parks, those kind of asset classes, which are all great, but they're kind of like newer niche asset classes, right? Not multifamily, but like some of the other ones. And I feel like the traditional asset classes of retail, office, industrial is kind of where flex still kind of lives. So like, I mean, the biggest difference is you're not really running a month to month or a day to day business. You're running, long-term lease terms. You really need to understand how a triple net lease works versus a modified gross lease versus how to work with local brokers versus national brokers and like how the management of all that works. So it is a little bit different. I mean, I do feel like in a hotel, especially, I mean, that is as much of a business. I mean, you know this better than anybody, but like this is as much of a business as it is a real estate play, right? Like, 100%. And what we're doing, it is truly a real estate play throughout. I mean, there is a decent amount of hands-on management, but it's not nearly to the scale of really a multi-hotel or any of those asset classes. So it's a little bit different. It's a little bit more traditional real estate, I'd say.
So when you're underwriting an industrial, like flex space, mm-hmm. What are the drivers of value?
Yeah. And so like, that's really why we came into the space to start with, is like, we kind of sat back and we're like, okay, what is like kind of the basis of investing as a whole, right? And that's supply demand is kind of how we see things. And so you had a ton of demand of you had a ton of supply of self-storage come in. You had a ton of supply of, multifamily, hotel, a lot of other asset classes. And we came across, and there was a lot of industrial being built at that time too, like big bulk industrial, like your typical, like 300,000 square foot Amazon warehouse distribution center, right?
Yeah.
But the flex stuff, which also I'll kind of like back up and explain that real fast, just if somebody doesn't know what we're talking about. Flex industrial is a multi-tenant building, usually call it 50 to 100,000 square feet. That's made up of maybe 20 to 30 like smaller office warehouse suites in between it. So it looks kind of like a business park, but it has roll-ups or dock highs on the back, and each suite is maybe like 4,000 square feet, with 1,000 of that being office, 3,000 being warehouse. So that's what we're buying. So we started looking around and just trying to figure out like, where is the supply demand imbalance? And we came across flex because really no one's built that product in the last 30 years. And we also quickly figured out, because our first thought was like, well, let's build flex in the Gulf Coast, because there's none of that product down here where we are. And we quickly figured out, I was like, hey, the rents don't really support new product. And then we started looking at other markets. We're like, oh, that's kind of the truth throughout the whole Southeast. Like, to be able to build new product, you have to be, call it $15-$16 or in a square foot in rents, triple net. And most markets are 8 to 12. And so you can go in and buy an asset that's currently renting at, I don't know, $6-7 a foot, push it to 10 to 12. So you have really good upside there, but then no one else is coming in on top of you because the market's at 12. It's not at 15. So, high demand, low supply, not accretive to be able to build new supply. So it's a really good place for us to sit, was the basis of that whole thought process.
Yeah.
But yeah.
Interesting. So for you just saw the opportunity in the market. You're saying, hey, there's a limited amount of supply, which means that we can charge, above market rents or above traditional market rents, I should say, right?
Yeah. Well, they'll just continue to push, right? Like, it's old school supply demand that we all had in Econ 101, right? Like, if supply is constant, demand rises, then prices rise, right?
Sure. So what protections do you have in place? So like, how are you making sure that there's, how can you ensure that no more supply is introduced to the area, right? So like, if like one of the key drivers is like, hey, we see an opportunity because there's a limited amount of supply, what guarantees are there, right? Because as far as I'm concerned, I don't know that there are any guarantees, right? So how are you?
Yeah, there's definitely not. Yeah. And like, I do think long term, we feel like new product wouldn't be needed, whether that's from us or whether that's from a competitor. I mean, at the end of the day, demand is so high. We're investing in Southeastern Sunbelt markets that are growing the population rapidly. Like, there's going to need to be new supply, but we kind of are okay with that because of the fact that we're buying these deals at well below replacement cost. So our basis is about $90 a foot throughout our portfolio. New constructions call 140, 160. So really our whole thought is let's buy as much of it as we can when rents are 10 to $12. if somebody starts building on top of us, they're going to be at 15, 16. We can push to, I don't know, 14, still be undercutting them, but we just increase the value of our building by, what would that be, 30%. So we're kind of okay with new product. I mean, obviously every asset class eventually will most likely get overbuilt, but we think there's a really long runway there before that happens, that we will be able to participate in that kind of, was it rising tide raises all ships kind of thing, like that the whole market will continue to rise as we're able to have a lower basis than everyone as well.
It's interesting. So you basically have identified where there markets where there's a large population / economic, burst of like population and economic growth, and the infrastructure, the flex industrial infrastructure, like the supply that already exists because of like this like wave of growth is essentially like pushing the rents well above where you're used to seeing them. Is that more or less kind of like a good summary? Okay.
That is a good summary. Yeah. So we're mainly buying from like more like legacy owner guys that maybe bought these properties in late 90s, early 2000s, and their basis is so low that they don't mind being at $5-6 a foot, because to them they're like, hey, look at what we're making. We're making $300,000 a year. I'm like, yeah, but you could be making $600,000 a year. It's but hey, that's good upside for us.
Yeah, 100%. 100%. That's really interesting, man. So I feel, because I definitely have seen, I would say, an increase in the awareness, right? Like the awareness from a casual investor in terms of the upside on flex industrial. So
it's definitely getting like kind of a foothold. Like you hear about it on podcasts now, like it's starting to like kind of you really get going. Yeah.
So where do you think that's coming from?
I mean, I just think that as people get pushed out of other asset classes, they have to find a home, right? Like money has to be placed somewhere. And so whether that's coming from all the way up in the institutional game to all the way down to just the high net worth individuals out buying property for themselves. I mean, with where we sit today, multifamily is obviously in a little bit of a weird place. Self-storage is in kind of a weird place. Office is, for all intents and purposes, pretty dead. And so that just kind of corners the market in like, where does all this money need to go? And so there's only so many asset classes out there and so many places to go. And I think it's a good story, right? It's a simple enough story, the supply demand story of flex. You really start looking at it. Everyone's at high 90s occupancy. Rents continue to grow. It's real estate, right? Like it's not rocket science. Like at the end of the day, it's it's pretty simple, right? If we can figure it out from Alabama, other people can't too, I think. So, but yeah, I mean, I think that's a big part of it. And I think that it feels kind of similar to how self-storage was back in like 15, 16. That was like real mom and pop owned, wasn't really a whole lot of new, nice supply coming in. And then all of a sudden kind of people figured it out and started investing in it, and then started building it. And then it got to be like one of the main major food groups of real estate, right? And like, I kind of feel like that's kind of the trend that we're seeing play out a little bit.